We are very honored to have three very distinguished members from the official sector who are involved in thinking about the risks that face the financial system and how best to regulate it. I don't envy them at all because they have very, very difficult tasks. And all the challenges that we talked about in the previous panel, they are the ones who are going to be dealing with them. So it's not an enviable position to be in. But as we discussed in the previous panel, regulation involves a key balance, and that's a group that has been tasked with developing a financial regulatory system for the 21st century. So as I said, no easy task at all. J.W. Verrett is a senior scholar at the Mercator Center at George Mason University. He is also assistant professor of law at the George Mason School of Law. He recently completed his tenure as chief economist at the House Financial Services Committee and has returned to academia. J.W. Verrett is going to be moderating this next discussion. So please join me in welcoming a group of panelists. Thank you very much.
Thanks, Ben, and thank all of you for coming today. We really appreciate you joining us and spending some time with the Mercator Center thinking through financial policy issues and how they affect financing the future. I thought today we'd begin by introducing our panelists for the government panel, the government regulator panel, and we'll have a few questions. We'll have a little discussion, light discussion, as we're the lunch act today, and then we'll open it up for a few questions, a few short, in the form of a questions from the audience. So it's my pleasure to introduce today's panel to you. Director Richard Berner of the Office of Financial Research at the Treasury Department joins us today. Director Berner, before that, was chief economist at a number of different investment banks and also spent a significant time as a researcher for the Federal Reserve. Vice Chairman Honig joins us today from the FDIC. Dr. Honig spent a large part of his career, as most of you know, as the president of the Federal Reserve Bank of Kansas, and also was in bank supervision, was a career bank examiner in bank supervision at the Federal Reserve Bank of Kansas. And Wikipedia also tells me that his dad owned a plumbing business in Iowa. And you know, I was going to make a joke about how that prepared you to regulate the financial plumbing, the plumbing of the financial sector. But I thought better of it. So I'm not going to do that.
Oh, I can give you some real images of that.
Okay, good. Good. Commissioner Mike Pivovar joins us from the Securities and Exchange Commission. Commissioner Pivovar was, before that, chief economist at the Senate Banking Committee, which is not as cool as being chief economist at the House Financial Services Committee. It's actually a known fact. But before that, Dr. Pivovar has done a number of things, including serving as an economist at the Council of Economic Advisors at the White House under President Obama and President Bush, and also was a finance professor at Iowa State. And if you Google Commissioner Mike Pivovar, there's actually two famous Mike Pivovars. The other one is I'm not kidding about this, is a championship skateboarder. Who's,
all right.
It's true, Mike Pivovar.
That's right. He's way cooler than I am.
He's way cooler, but they both, one in the context of skateboarding tricks, the other in financial regulation. They both have rad moves. They share that in common. So we're really glad to have our panel here with us. I have a couple of questions prepared just to tee up discussion, but I definitely want our panel to play off of each other, and feel free, after one panelist has spoken, if you want to chime in and get a little debate going or discussion going, that'd be great. We'll do that for about half an hour or so, and then we'll open it up to questions. So first, let me start. This is one of I think my first time probably interviewing a group of people, and so I immediately thought, let me think of my favorite interviewer, James Lipton, on Inside the Actors Studio. Have you all ever watched this? And he always has at the end a series of questions he asks every actor that kind of tells them who they are and what they are, and what's your favorite word, what's your least favorite word, what's your favorite curse word. By the way, Robin Williams' answers to all of those things was pretty interesting if you go look it up. So my version of that, to open it up, is just something like, what's your favorite provision in Dodd-Frank? What's your least favorite provision in Dodd-Frank? But that might be a little too simplistic or maybe a little too controversial. So I can ask it a different way of, what provision in Dodd-Frank do you think worked particularly well, from the statutory authorization to the implementation by way of notice and comment, to the implementation internally in compliance departments across the country? What worked particularly well? What seemed to have worked as expected? What did not work well? What worked unexpectedly? Because in some sense, Dodd-Frank is so massive. It's a study in administrative process. It's a study in political economy. So I thought I'd sort of tee up a good and a bad on Dodd-Frank. Now, if you don't want to get into a normative judgment, just a positive assessment of what was expected, what worked as expected, what worked unexpectedly. So with that, Director Berner, any thoughts on that one?
Sure. First of all, let me just thank you, JW, for inviting me here today, and thank the Mercatus Center for sponsoring this conference. It's really cool to be up here, especially with two guys I know well and have a lot of respect for, so that's great. You know, it's going to be pretty obvious to you that what I think worked well in Dodd-Frank was the setting up of the Office of Financial Research. I knew I'd get a laugh out of that, but I think it's really important because the crisis exposed the fact that we had serious deficiencies in our understanding of the financial system, particularly how it functioned or didn't under stress. And we had serious gaps in the way we measure financial activity in our data, and the office is trying to fill those gaps on both counts. And so I think that's worked particularly well.
Do you tend to hire academic economists, private sector economists, a little bit of both? How do they acclimate to the environment at OFR?
Well, we don't hire just economists. We have data scientists, we have finance professionals, we have folks who specialize in different disciplines, because we think an interdisciplinary approach to the work that we're doing probably is one that's going to give us the best perspective, the most holistic view, so we can look across the financial system.
And how has the interaction been with the economic divisions at agencies and departments, for those that have them? How's that worked?
You know, in the context of the Financial Stability Oversight Council, I think everybody recognizes this is a team sport. We all need to collaborate together because the job is big. So with both my colleagues to the left, both with Tom at the FDIC and Mike at the SEC, we have collaborative engagement underway in a variety of areas. And I think that's really important for getting our job done. It's particularly important because we, in the OFR, do not make policy. So we have no authority to make policy except with regard to certain aspects of data standards. And we rely on them to make policy. Our job is to inform them and to help them in making the decisions that they make. But because they are primary regulators for certain parts of the financial services industry, we need to collaborate with them in order to get our job done, to fill those data gaps, to improve the quality of financial data and promote the use of data standards, and to do the analysis that we need to do.
Anybody else want to jump in on that?
On what works well?
No, just what works well, what doesn't work well, and also anything about OFR.
Sure, I'll talk about what, you know, it's been 5 years since Dodd-Frank has passed, so it's too early to tell what's worked well and what hasn't worked well. I say that only half jokingly. Some people are nodding their heads, some people are sort of laughing. But the fact remains, what Dodd-Frank did was tell the regulators to go forth and promulgate about 400 new rules, of which the SEC is responsible on an individual or joint basis for about 100 of them. And by simple count, we're somewhere between halfway and 2/3 of the way done. What that means is that we still have a third yet to get written. So that's taking up a lot of our bandwidth at the SEC. What it also means is that the 2/3 that are done, we're just starting to stand up on the you asked about compliance, enforcement, and all those sorts of things. And so, you know, in some ways it is kind of too early to tell what works well, what doesn't work well within Dodd-Frank. Having said that, some of the provisions in Dodd-Frank that I think did work well and we're in the process of implementing right now or have already implemented, as Phil Swagel mentioned in the last panel, you know, the ones that were not solutions in search of problems. So ones that were solutions to real problems that we saw. One of the provisions that I think is working particularly well, and we're starting to implement it agency-wide, is Section 939A, which is the removal of references to credit ratings in all of our regulatory rules. There's been literally dozens of narratives about what caused the crisis, but I think one thing that's common across all those narratives was that there was an over-reliance on credit ratings. And part of that over-reliance was due to the fact that the government, in various ways, sort of blessed credit ratings as a way to measure risk, and people were not doing their own due diligence. And so one of the provisions in DoddFrank required all the financial regulators to go through our rules and scrub them of references to credit ratings and put in other sorts of ways to sort of encourage investors and creditors out there to do their own due diligence. And I think that's something that is working well, and we'll try to, and will possibly help prevent the same things from happening again.
Okay.
Well, I agree that it's probably too soon to tell, but in this context, for me, the overarching goal of Dodd-Frank was to end too big to fail and to assure us greater financial stability. And we have a ways to go before we know whether we've achieved that goal. And I do have concerns. I think the issue of moral hazard remains a major issue. I think the safety net has not been contained. I think through practice and through actions, even in the statute, we've extended the safety net to a greater number of firms. I think the largest firms in this country are protected by it. They've become, in essence, if you will, almost like GSEs because they are thought to be too big to fail. And we haven't assured ourselves that that issue has been addressed. And when you think about it, we add the CCPs to this because they now have access to the discount window. So I want to see how this works its way through because right now I am concerned that the safety net's being extended. And when you do that, you incent people to take on excessive risk, and you incent these companies to keep their capital as low as possible because they have the safety net giving them and their lenders, if you will, their creditors, whether they're depositors or else, incentives to give them that money without a clear due diligence. And on your table is what I call the Global Capital Index. And I want you to look at the right-hand highlighted column of that, and that's the real capital ratio of these largest institutions in the world. And they run between 4 and 5% of assets under international accounting standards. And that's far too low. We know from history that's far too low. So we have a ways to go. And whether Dodd-Frank brings us further along, I think that's the question that we have to wait to see the answer to.
Now let me ask you this. So you mentioned capital ratios as a way to think about where we are with respect to bank regulation and safety. And do you have any thoughts about the debate going on in the economics literature about measuring the subsidy? Because there's been a number of attempts to measure the subsidy that large banks, large financial institutions obtain from the safety net, from the implicit too big to fail dynamic that that proponents of that approach argue still exists. And at the same time, there's what I thought was a very compelling paper by Randy Krosner that the Clearinghouse put out that does a lit survey of that debate and thinks about, well, if you think there's a too big to fail subsidy here, look at the differential in lending costs based on size in other industries. It's even bigger in other industries. It seemed like a pretty compelling paper, and yet so it seems like finding a metric to measure the exact subsidy seems to be a bit of a holy grail. At the same time, there seems to be dynamics that would suggest pretty broad safety net coverage. I wonder what your thoughts are about that debate.
Yeah, I've seen those studies, and I understand that you can do different things to get different answers, but most of the independent studies, or what I judge independent academic, most in terms of IMF, OECD, are very clear that there is a substantial subsidy that comes along with the safety net, the discount window access that no one else has, the deposit insurance that many of these firms have, and that is, by most of those studies, measurable and announced, number one. Number two, I say judge by their actions. I mean, why did GE want a bank to begin with? And now they're getting rid of it because you put the pressure on them to remove the subsidy. Why all the effort to get rid of the push-out rule? Because they could have put those activities in the affiliated broker-dealer. But where did they want them? They wanted them in the commercial bank. And guess what? That's where you have direct access to the discount window and direct access to this deposit insurance. They didn't want it in the broker-dealer. Could have done it just as easily there. But it costs more. That tells me a lot. Actions always tell you a lot. And the actions are there's a subsidy there and they're grabbing it as they push hard for that rent.
Okay, so speaking of subsidy, let's go back a little bit to something Vice Chairman Honig mentioned, the counterparties, central counterparties. I want to ask Director Berner, a recent OFR report got into the issue of central counterparties and potential risks that exist in these central counterparties that were built up by DoddFrank, explicitly created, given access, again, as Vice Chairman Honig mentioned, to the discount window explicitly. What do you want to tell us about what the work that OFR has been doing, examining central counterparties, and your assessment of the information regulators have at hand to help them deal with that potential risk?
Well, thanks. But first, let's just step back a little bit and understand why in Dodd-Frank central clearing was mandated. The point of central clearing is obviously to see some benefits from it for the derivatives market, in which we learned prior to the crisis that the huge buildup of those markets actually was accompanied by excessive risk-taking. And so the goals of central clearing are pretty clear. They're to make the market more transparent, to achieve the netting benefits of positions in central clearing. So I think that those are substantial goals. The key, however, is obviously that you are concentrating risk as well as reducing it through that central clearing process. And so it's extremely important, and Tom was, I think, implying this in his comments, that when you concentrate some of those risks in the central counterparties themselves, that you need to look at those risks and those entities and the way that they operate very carefully. And I think regulators are aware of this. The facts are that we haven't finished the work that needs to be done to assure the strength and resilience of those central counterparties. And I think the remedies there and the things that would make them strong and resilient are pretty well known. Improvements in risk management practices, including stress testing, improvements in liquidity buffers, improvements in capital buffers. Those are things that are extremely important in making these entities resilient. But I'd stress one more point, and our work underscores this, and that is that we can't look at central counterparties in isolation. We have to look at them, as we do other parts of the financial system, as part of the system. So if a major counterparty of a central counterparty fails, the question is not just what does that mean for the health and the resilience of that particular entity, but what does it mean as it reverberates across the financial system? Because the chances are if a major counterparty fails, they will be clearing on multiple platforms. They'll be clearing in more than just one central counterparty. So we have to look at the system as a system. We have to look across the network and see what the implications of that are. And being interconnected in the way that they are, central counterparties and their major counterparties, we have to look at it as links in the chain, and the chain will only be as strong as its weakest link. So I'd go even further than what Tom said, which is we can't just look at them in isolation. We have to look at them as part of a system. We have to make sure that each link in the chain is strong.
Now, in the initial rulemakings when central counterparties were being set up, it appeared that the SEC and the CFTC put a particular emphasis on the corporate governance of these entities as they were created, both in terms of ownership limitations of firms interacting with these central counterparties and also how they would be governed. Have you found in OFR's research a big link between corporate governance and risk management to justify that sort of emphasis?
We have not examined that in particular for central counterparties, but there's no doubt in my mind that the governance around risk management in financial services companies and entities since the crisis has begun to change in a favorable way.
How so?
Chief risk officers are now reporting to the CEO.
Okay.
Chief risk officers are empowered to look across their firms on an enterprise-wide basis, and that's all necessary. So are there more improvements that are needed? Sure. Our second working paper actually addressed what some of the best practices in risk management in general are, and corporate governance is an ingredient in that. So you need a strong management structure. You need strong governance to make risk management practice work. You can't just put it down on paper and expect it to work. So that is a strong element, but we have not looked at that in the context, in particular, of CCPs.
So in terms of what constitutes good corporate governance, the specific you think would be helpful is the direct reporting of chief risk officer to the board.
That's one ingredient.
Okay.
Yeah, that's one ingredient.
Now let me step back a little bit back to the broad safety net issue and then zero in on something different with a question for Vice Chairman Honig. So I voraciously read the Geithner book, Chairman Baer's book. Doesn't seem like they agreed on a lot. But one thing they agreed on was they both did not like the provision in DoddFrank limiting the ability of the FDIC to guarantee bank debt. By that I mean not commercial deposits, but the ability to guarantee other debts issued by banks. DoddFrank limited the ability of the FDIC to issue some of the wide guarantees that were done during the crisis. So despite disagreeing on a great many things, both in terms of telling the narrative of the crisis, in terms of policy, Chairman Baer and Secretary Geithner both agreed that it's setting us up for failure in the future, that FDIC's broad guarantee powers for bank debt have been restricted or limited. They require a sort of a congressional approval process to operate. I'd be interested, given how much work you've done on the safety net, what do you think about that? Do you think that it's minimized moral hazard, it's going to be effective? Do you think there could be some potential negative side effects to that limitation? And it's all, I should add too, this is all in the context of the FDIC's broad guarantees for bank debt have been limited, but the Fed's 13.3 powers and the Fed's discount window is still there and has not been limited nearly as much. A little bit, not very much by DoddFrank.
Well, I think that the idea of limiting the guarantees is a fundamental in terms of limiting moral hazard. I understand what they're after, and I see I don't see that that's a big problem, because my experience is that if there's another crisis like that, you'll get Congress to pass another TARP, and I think they should be the ones taking responsibility for it, because the reinsurer for the FDIC is the federal government. So if we guarantee every liability in the world, or every liability in every bank in this country, with our, let's say by then, $100 billion of deposit insurance, I think everyone knows that the government's behind it, and I think that's fine. If the Congress wants to pass it and the President wants to sign it, it'll be open. But I don't think it should be up to the FDIC or the Fed to decide what's now guaranteed and what's not. If we're going to guarantee everything, then let Congress act and guarantee it now, and you can see what's going to happen. But if you create, well, we're not going to do it, you're not guaranteed unless we decide you're guaranteed, what you do is create moral hazard, uncertainty, and all kinds of other consequences. So give me the rules to run by, and we'll run by it. And if you want to make exception, Congress, you pass it.
So you're hopeful that statutory reform of the lender of last resort function at agencies can still reduce moral hazard, even though there's always that prospect of the appropriated congressional bailout.
Yeah, that's, judge me by my actions, and everyone knows that in a crisis, probably the Congress will be acting, but I think it's the Congress who should be acting.
Now, moving to statutory reform of 13.3, there was a little bit in Dodd-Frank. There's a much more direct, much more certainly blunt instrument in a Warren Vitter proposal to put just an absolute 500 basis point requirement on 13.3 lending. Do you hold out much hope? Do you have much interest in? Do you support the idea of 13.3 restrictions in statute? And that one in particular, that particular approach.
Well, I think the idea of that is is to bring back the idea that if you are going to lend in a crisis for good collateral, that you have a penalty rate. You know, that's as old as the 19th century. And I think that's perfectly legitimate. Whether or not you will do it in a crisis, I doubt, because Congress will in fact pass it, and we will be making loans whatever conditions they require, and I just assume it be them deciding. I think in an emergency, the ability, I'm not so much concerned in an emergency that the idea is you would lend to the commercial banking industry who could provide liquidity. But as we extend this safety net through 13.3 to money markets and to other types of non-bank activities, what you've done is made the Federal Reserve the counterparty to all risk of liquidity out there. Maybe you think that's a good idea. I think it creates an enormous moral hazard issue that then you have to manage through time as you increase your risk profile, and you will see these capital numbers are substantially lower than they would otherwise be if there wasn't the idea of the government stepping in and protecting these creditors in these largest banks. So
is it fair to say you're a supporter of some of the economists at the Richmond Fed, sort of the Richmond Fed view that has emerged, as I associate in my mind anyway, is that most of the traditional Fed lender of last resort function can be performed through open market operations in lieu of directed, targeted support to particular institutions. Do you think that's a bridge too far? Or?
Well, I mean, that's certainly one way that liquidity has been provided into the market broadly. I don't think there's anything wrong with the lender of last resort for specific. For example, if you had a crisis develop, and let's say one of 12 banks was insolvent. You let that fail, and then you lend to the other 11 massively, individually, but against good collateral, and you get through the crisis, but you allow the one to fail. But if you don't have that lender of last resort, then that becomes much more difficult. And believe me, I understand it takes a lot to allow the one to fail, especially given the size of that one today and the complexities around it. But if you don't start by limiting the coverage, you are in fact guaranteeing all. And you know, if you look at that table, banks that are not assured the too big to fail stat hold twice as much capital. Twice as much capital. And there is the first line of defense in a crisis and in failure. And they'll ignore it if you give them assurances that the government will come in and bail them out.
Commissioner Pivovar.
Yes.
We've been letting you off the hook for a little bit.
Yeah, I've never been the quiet one on the panel before.
Yeah.
This is amazing. Actually, one quick thing before
I
forget.
Go ahead, jump in.
One of my counsels is reminding me I need to do my standard disclaimer saying any views I express are my own, don't necessarily reflect anyone else at the SEC. Okay, good, we're done.
But it could mean, it still could be that you're right.
Yeah, that's
wrong,
right. It always means that. Yeah.
Yeah. So in a speech last month, you called for an application of market-based prudential regulation to banks. What does that look like? What does that mean? How does it make them safer?
Sure. So I talked about what I call market-based prudential regulation as an alternative to the current sort of system that Congressman Garrett mentioned today. He called, what did he call it, the shadow regulatory system. And the idea here is to use the SEC's disclosure regime as a way to do two things. One, provide material information for investors and creditors in large, complex financial institutions to help them make better investment decisions and better credit decisions. And two, to help make the banking system safer and more sound. SEC staff is currently working on something called Industry Guide 3. The SEC, we have these industry guides, which are additional disclosures of financial information that firms in certain industries have to provide over and above all the regular types of information they have to provide in their financial statements, and Industry Guide 3 is for banking organizations. Industry Guide 3 has not been updated since 1986. Banks have changed a little bit since then. So in the interest of doing retrospective reviews of our existing rules and guidance and those sorts of things, it's just good government for us to go back and look at that. I think there's an opportunity in looking in Industry Guide 3 to provide some additional information, like I said, to give investors and creditors better information, and also give an insight into what's going on the regulatory side. And I gave 3 examples of things that I thought would be particularly relevant to investors and creditors to help them then price the stocks and the bonds and then get more accurate information in the marketplace. The first is better information about the impact of the Fed's Comprehensive Capital Analysis Review Program, or CCAR process. This is the process by which banks submit to the Fed their capital plans over the next few years, and the Fed does stress tests under various scenarios and comes back to them and says, yeah, you need to, your capital plan is fine, or you need to go out and raise additional equity, or no, you can't pay those dividends. Anything that's directly related to banks' ability to go out or being mandated to go out and raise equity or the dividend policies is directly relevant to shareholders. Second would be the resolution plans or the living will process. This would give creditors in particular and investors information about how banks would be treated in bankruptcy. This is relevant information I think should be out there in the marketplace. And then thirdly, we're going to perhaps talk a little bit about this later, and I know the Mercatus Center has been very good about this, thinking through about the costs and benefits of regulations, providing a way for particularly large financial institutions to explain all the different costs, whether they're direct costs, expenses, or opportunity costs related to all the regulatory burdens that they're facing, whether it's from Basel or DoddFrank or other types of regulation that's out there. It directly hits the bottom line in terms of expense ratios, net income, and it directly affects the bottom line for investors in terms of growth opportunities going forward. Those are 3 that I came up with. I look forward to feedback from folks on ideas that they have in terms of providing that relevant information. But it's a way of using our disclosure regime to get that information into the marketplace and then have the securities of those firms be priced accurately. And as Manley Johnson talked about this morning, then using the capital markets to then as a mechanism for having capital flow to its most productive uses.
So I wonder, as you think about using the disclosure system to regulate banks or to regulate bank risk, there's been a discussion about banks seeking access to the discount window, financial institutions going to the discount window, the possibility of real-time disclosure of that, inhibiting banks from doing so in the first place, shaming effects of that. Do you think it's a material event requiring filing an 8K whenever a financial institution or its sub go to the discount window?
That's a good question. I haven't thought about it. But to your point, what's important here is it's not using our disclosure regime for bank regulatory purposes. It's using our disclosure regime for what it's meant for, providing material information to investors. One of the things that drives me nuts about DoddFrank is there's a number of provisions in there that turn us into a special interest disclosure agency that have nothing to do with material information to investors. I think these things would provide material information to investors. Perhaps what you brought up, I hadn't thought through it. That's something we can think about. And we have the added benefit that it would also help provide a safer, more sound banking system as an added benefit from it.
All right, well, we're getting ready to transition to audience questions, am I right? A couple more minutes. As we let folks line up and start thinking about what they want to ask, let me ask one last question for our whole panel. It seems like we have, so I'm thinking back to when, during the last panel, I was thinking back to when I was a law student in Professor Hal Scott's securities law class in 2006. You survived that? I did survive that experience. But I had, no, actually it must have been, anyway, it was just after the implementation of Sarbanes-Oxley. We talked a lot about SOX implementation in your class. Of course, you had very strong views. I'd come to agree with them. I thought at the time, surely must be exaggerating, but I've come to agree with pretty much everything you said. But it does seem like every 5-10 years we have some major either financial crisis or financial scandal that results in a regulatory change. So I'm asking you all to pull out your crystal balls here. Think about the future. Where is the next financial crisis or maybe just scandal resulting in regulation going to originate? Is it going to be a cyber thing? Is it going to be a state pension fund meltdown thing? Is it going to be a liquidity crisis? All of the above, something else? Where's it going to be? I need to tell my broker what to do. So where do you see the next thing being?
Who do you want to start?
Director Brunner.
All right. I don't think we can predict with any certainty where the next financial crisis will originate. And that's not my job. It may surprise you to learn that, but I think that what we need to do is to look where the vulnerabilities in the financial system are and the weaknesses, and if we can spot those, then we probably have a good bet on where we need to strengthen the financial system and to shore up those vulnerabilities, because if we make the financial system resilient, and I've used that word a couple of times, then we have a better chance of having the financial system continue to function even under stress. That's my definition of financial stability, and I think it is widely shared by others. If we can do that, then it's not so much that we can avoid or decide where and when the next financial crisis will occur. It's that we can survive it, like you survived your class with Professor Scott, and that we'll come through it stronger and safer in the future.
So where's the chief area of concern? OFR's got a lot of reports. In fairness, you've highlighted a bunch of different areas over your tenure. But
yeah,
what worries you the most?
There's a bunch of things that are still vulnerable, and in our annual report, which we published 6 months ago, I think it's still valid 6 months later, 3 areas that we are concerned about. One, that we've seen in this environment of low interest rates and low volatility, a lot of reach for yield, a lot of risk taking, and the consequences of that are yet to be seen, but that's something that we are continuing to monitor and focus on. Second, and I know it was discussed both here and it's been discussed in lots of other places recently, that for a number of reasons, and in certain financial markets and certain asset classes, we have seen a decline in trading or market liquidity in those asset classes. And you know, I think that that's something we want to continue to try to understand and to try to assess what the consequences are, because a shock is likely to have more severe consequences in terms of price and action and potentially spill over across the financial system in that context. And then the last one is important, and it kind of relates to your question, and that is the migration of financial activity from one part of the system to another. You know, DoddFrank, whatever you think its flaws and its merits are, and regulations around the world have made the banking system stronger. And whatever you think the level of capital is now, if you look at Tom's table, or I'm sure that Tom would agree that whatever it is today, it was probably lower in the past. And capital is extremely important as a buffer against loss and as an incentive to limit the extent of leverage and risk-taking through that channel. But as we make the banking system stronger and we haven't focused on other parts of the financial system, then activity tends to migrate towards other parts, towards presumably less resilient and likely more opaque parts of the financial system. And those are things that we need to be aware of and track. And I would say that, you know, we haven't talked much about data, although I alluded to it earlier. We still have big gaps in our ability to measure financial activity and in having high quality data in order to do that. And that's something we're committed to doing. It's something I think the regulatory and policymaking community can pay more attention to.
Okay. Vice Chairman
Honig? My rule is follow the leverage, and if you know, that's part of my issue with extending the safety net. It encourages leverage. If you look at those areas that become highly leveraged off a long-term trend line, those are candidates. I can't predict any more than anyone else can where it's going to come from, I would tell you. But if there's leverage, there's a higher probability of that's where the crisis goes, whether it's money markets who now have a safety net and lever up or keep pushing towards the edge or what, you'll find it following the leverage. Number one. Number two, I just want to remark, yes, the banking industry is better capitalized than it was in 2007, but that's hardly saying anything when you had virtually like less than 3% leverage, and now you have a little more than 4.5%. I don't think you're out of the woods by any means, so you still have a highly leveraged. And look, I understand this concern about the shadow banks. However, most of our worst problems have come come from regulated, whether it was the broker-dealers, investment banks that were regulated, or the banking industry. When you go into these non-banks, many of them have much more equity than the banking industry does. So it's not just that they're migrating, it's how are they migrating and what is the leverage position of those firms that they're migrating to. So I don't necessarily panic when I hear it's going outside of the banking industry unless I see it being subsidized and levering up, and then you got a problem.
Commissioner?
Yeah, so if I had to pick one, I would say cybersecurity. You know, we just heard that apparently the Chinese have all of our background check information and social security numbers and all kinds of other things. One of the things that concerns me about in terms of financial crises is the, the ability of cyber attackers from all over the world not taking information to get our personal information to then exploit it and steal money out of our accounts, but using that information to somehow potentially destabilize the banking system. We're hearing stories of overseas of them trying to destabilize particular systems over there. We had a roundtable in March of 2014. I asked the question of when I think of cyber attackers, what should I think of? State-sponsored cyber attackers, organized crime, teenagers in their parents' basement and all that stuff? And the answer was yes, all of those. And the most vulnerable, the ones that are most often attacked are the financial institutions. Why? Because that's where the money is. I think the regulators were trying to get a handle on that. Commissioner Aguilar at the SEC has said we should have a task force at the SEC dedicated solely to cybersecurity. I agree with him. We do a number of things around the edges on cybersecurity, but I think this is such an important issue that we need to be looking at this in isolation. There are some at the government, macro government level that think that cybersecurity is so important that Homeland Security, Department of Homeland Security needs to be in charge of this whole thing. I think that would be the exact wrong thing to do. I think the financial regulators collectively here in the Department of Treasury are ahead of the curve in a number of ways. The financial institutions themselves are ahead of the curve in a number of ways. But it's one of those things where it's like playing defense in football. You're a cornerback, right? You got to be right every single time, or else they get one on you. And so it's one of those things where we have to constantly be vigilant in this space.
All right. Well, I will delete my banking app on my iPhone right away.
It's already been done.
Yes.
You just don't know it.
It's already been hacked.
All right. Any of our panelists have any final thoughts? Anything you really want to get out there? This has been a terrific discussion. I really want to thank our panelists for joining us. Please, everyone, join us in thanking our panelists.
Thank you.
Back to Ben.
Thank you very much. Another big thank you to our panelists who have given us a lot to chew on. And they've been very generous with their time with us. This brings us to the close of our events today. We are very grateful to all our panelists and speakers and our guests who took some time off their very busy schedules to join us. The issues we have discussed today are issues we at the Mercator Center at George Mason University grapple with every day. As you can see from the papers and books we put out today, we've been writing about them too. You can look to us for alternative views and ideas about how to maintain a robust financial market system. Our mission, as you know, at the Mercator Center is to help bridge the gap between academia and difficult policy questions. I hope our discussions today will inform your thinking about the financial system and financial policy in general. It has been a pleasure meeting you today, and feel free to connect with any of us, myself, or any of the staff members at the Mercator Center, so we can be a resource to you. Visit us on our website at www.mercatus.org. I'd like to thank Julie Burton, our Director of Event Strategy, for helping us put this together, and also Hester Paris, Senior Research Fellow, and our Director for the Financial Markets Working Group at the Mercator Center at George Mason University, who has really been a thought leader on this event. Thanks again for coming, and see you next time. Thank you.